both an art and a science, valuations are complex things and their impact is enormous, making the difference between generational wealth creation and a comfortable retirement. At BizVal, we know how tough it is to grow and run a business, which is exactly why we've made valuations simpler. Whether you are using our online tool BizVal Live or reaching out to us for a concierge offering where we spend more time on your numbers and your business and give you detailed feedback, you can be sure that the same techniques being used by professional investors are also being used by us. And with BizVal Bootcamp, we will prepare you for those discussions with investors. Welcome to the BizVal Podcast. Welcome to this episode of the BizVal Podcast. I'm your host, The Finance Ghost. I'm so excited to have this discussion today with Mark Davidson on the other side of the world where they have electricity just outside Glasgow. Mark is from Crest Business Advisory. And Mark, I'm really happy that you've made some time for us today. I think you have an enormous amount to share with us on, I guess, deal making in the UK and perhaps just that sort of international mindset.
Great, thank you. No, pleasure to be here and I'm looking forward to our conversation.
I'm being reminded by how difficult it is to do business in South Africa right now because I thought my laptop was fully charged. I have load shedding currently. Anyone listening to this in Mark's network overseas, that means the power is out in South Africa at the moment for roughly 8 hours a day, just in different segments. So at least they tell you when it's going out. So this is my absolute rookie error for not having a fully charged laptop, but I think we'll be okay. Mark, no doubt challenges on that side, but at least you do have electricity for a full day, which does help, I have no doubt. I think before we jump into some of your insights into deal making in the region, it would be cool to just understand a little bit more about you, your background. How did you get to where you are today?
Sure, no, thanks, Ghost. So my background is that I've had over 25 years experience in business. I actually started off my career as an accountant, qualified accountant. But after about 7 or 8 years, I moved quite quickly into commercial roles. And I've been fortunate enough to work for 3 large corporates where I gained a huge amount of experience. So I spent 11 years with Johnson & Johnson with the medical device sectors. And I was really fortunate there to gain experience in different commercial functions. So worked in marketing roles, market access, and then also commercial leadership roles. I then moved to a Swedish multinational called Mölnlycke. It's one of the top 3 wound care companies globally. And I was working within the corporate development team in a strategic marketing role. And I was working really closely with the M&A team there and absolutely loved it. Loved the work that they did and felt like it was a really good fit for me. So I was fortunate enough to be offered the opportunity to move into a pure kind of M&A corporate development role. And then I moved, my last corporate role was with a UK PLC called Halma. And I wanted to move to Halma because they're very acquisitive. They do multiple deals per year. And they have an interesting operating structure. So they operate like a long-term holding group. And they have about 55 or so operating companies across 3 different sectors. And I was working within the healthcare M&A sector. We were quite a small team and we owned the full end-to-end M&A process. So all the way from sourcing targets, valuing targets, strategically assessing targets, and also the segments that they operated in, and then obviously took those targets through a deal process, so due diligence, completion, etc. So amazing experience, very fast paced, quite intense, but it was great experience. And actually in that role, Ghost, that's where I really began to focus more on SMEs, which is small to medium sized enterprises. Halma is very focused on acquiring high quality SMEs, probably more at the upper end of that scale, so 2 to 3 million EBIT and above. Obviously for bolt-on deals, they do look at smaller sized companies, but certainly in terms of standalone deals, that would be a kind of sweet spot for Halma in terms of their acquisition criteria. So as part of that, I spoke with many SME owners, smaller than that and also bigger than that. So gave me great exposure into the SME market and how that is set up, particularly from an M&A perspective. And then since then, I left Halma at the end of the year and I set up Crest Business Advisory. And my focus really is on working with SME owners and really helping them to develop clarity on how they can maximize the value of their own business. And that may or may not be related to the owners wanting to sell their business in the future. About half of my clients are focused on developing and implementing growth strategies. So I take them through quite a detailed process of understanding where their business is today, where do they want it to be in, say, 3 years' time, and then together we build a roadmap to obviously enable them to get to that destination. But the other half actually are really focused on exiting their business, typically 1 to 3 years out. So I work with them to really create a path to a successful exit. And a successful exit means different things to different people, but directionally, that means obviously really maximizing the value of the company in the eyes of a buyer. But it's also about, navigating the complexities of the structure of a deal and supporting them to get to a point where a structure put forward by a buyer will be favorable to the seller and not just to the buyer as well. So a good mix of businesses, and really enjoying this new part of my career.
It's such a well-rounded experience that you've had, Mark. And I mean, I've spent some time both advising corporates who then don't typically do transactions. It's not their run-of-the-mill stuff. And then there are corporates that have these internal M&A teams, which you've also had experience in, where it's a bit more in the way of like bolt-on acquisitions, usually sometimes entirely new areas, but these are typically big corporates where deal making is in their DNA. And there's a very large difference between a corporate where deal making is part of that DNA and a corporate where it is not. And that's where they have either in-house teams or external advisors. I will also highlight that EBIT number. So for those who aren't sure, that's earnings before interest and tax, which is a nice proxy for operating profit after, allowing for depreciation and kind of making a rough assumption that maintenance capex probably looks a bit like depreciation. So EBIT's quite a nice metric to use. I think you said 2 to 3 million, no doubt great British pounds as opposed to rapidly depreciating South African rands. Just to give the South African listeners a sense of what an SME in the UK looks like. It's incredible, the sense of scale. From South Africa, particularly when we look at these international businesses, a small business in the UK is the size of a relatively sort of small listed development board kind of company in South Africa. If you just convert the currency, it just gives you an idea of how much bigger that market is.
Yeah, no, that's right. And yeah, touching on Halma, because I do think they're a very, very interesting company, and they actually fly under the radar quite a lot. It's amazing the number of people that I speak with who have never heard of Halma, but they are one of the top 50 companies in the UK by market cap. So they are a significantly sized company in the UK, and obviously they work internationally. But yeah, you're talking about the differences between corporates who have really embedded the M&A function within their organization versus those who maybe bring in experts as and when required, and Halma's obviously very much in the first camp. And I think that's a couple of reflections from myself with regards to Halma is that one of the key things for Halma in terms of deal making is that they are incredibly disciplined on their criteria. So the criteria with regards to the financial profile of the company, but also very important to Halma is the criteria connected to the market segment that target operates in. So we spent a lot of time not just on the numbers and looking at the financial metrics, but we spent a lot of time really getting into detail about the strategic dynamics of the space in which that target actually operates. Because one of the key things about Halma actually is that they're very much a long-term holder of the companies that they acquire. It's not a PE model of holding them 4, 5, 6 years and then sell. They very much look at a company through the lens of, do we believe this company will still create value for our shareholders in 20 to 30 years time? So as I say, as a result of that, we did spend a lot of time of really strategically assessing SMEs to really understand if they were going to be a good long-term fit for Halma.
Yeah, I mean, there's so much to unpack here, right? There's the sort of the way private equity thinks, which is often lots of debt, as you say, sort of 7-year holding period, maximum IRR, and no shortage of risk along the way. And then you get corporates who are kind of building up a portfolio of complementary businesses. They don't look to starve them with debt. They have no plans to exit in the next 5 to 7 years. They are looking to add on a strategic fit, buy a management team. It's a completely different buyer. And actually, entrepreneurs who haven't been through a sales process don't realize how different a financial buyer is from a strategic buyer. It's literally chalk and cheese. I mean, I'm guessing that's been your experience as well, Mark. That's certainly what I've seen in the South African market.
Oh, absolutely. I couldn't agree more with that. And, I think that my reflection now that I'm working directly with SMEs, particularly those that are looking to exit their company, is that, there really is a great opportunity if they plan in advance to really strategically position themselves to be an attractive target for corporates. It's because in my view, strategics typically are willing to pay a bit more for a target, particularly if they have a strong strategic fit. And what's the advice that I give to my SME clients who are looking to exit is really think through, who those strategics could be that could be a great home for your business. In my opinion, there's a great opportunity for SMEs to really think through where would my business, fit very, very well with a strategic acquirer. And then from that, you can really then start to, look into opportunities. For example, are there opportunities for joint ventures or strategic alliances with potential strategic partners? And that really gives an SME a foot in the door and, get onto the radar of these strategic acquirers. So it's certainly an area which, in my experience, is that SME owners typically don't really look at potential buyers through that lens. But for me, there are definitely opportunities.
So Mark, with all of that said and done around strategics and financial buyers and all of this kind of, this different approach, I suppose, obviously now you are advising SMEs. So I think what's really cool is you've now stepped outside of that. You've almost stepped, across the fence. And now you are advising SMEs who were previously the targets. So I suppose that puts you in a very good position to actually help SMEs, particularly when they are being acquired by these larger, scarier groups. And whenever I speak to founders who are looking at a deal like this, they so often make the mistake of not getting the correct professional help early enough in the process. They don't realize that in many cases, a lot of these corporates, let's be blunt, you're kind of dancing with wolves here. And if you go and do that without being adequately protected, having legal advice, having a proper financial person to help you, corporate financiers are the architects of these transactions. It's like going and trying to build a house without an architect. You wouldn't do that. And yet so many founders will go and try and sell their businesses without getting professional help. In your experience, where does that sort of go wrong? Where do SMEs get hurt in this process, and what should they be learning from that experience when dealing with large potential acquirers?
Yeah, I mean, firstly, I completely agree with your view there. I mean, it's certainly been my experience that, not always, but, in the main, SME owners don't really think strategically about their exit plan. For me, they need to be thinking at least 1 year out, preferably 2 to 3 years out, before they actually, take the company to the market. And exactly as you say, a very important component of that plan is getting the right advisors involved at an early stage. And many SME owners think of that as being a cost to their business, and perhaps that makes them a little bit reluctant to incur that cost. But in my view, it's very much an investment, and the work that you can do with different advisors to really prepare your company for sale in advance will more than pay for itself when you do actually exit the company. I think in terms of corporates and strategics, I mean, they're very, very good at having the key foundations in place within that business, obviously, and that's something that they really look for in SMEs. And when we talk about foundations in place, we're really talking about, does this company have a clear vision? Do they have a purpose? Do they have the right, the right culture which fits with our culture? But it's also looking at areas, such as, do they have a quality management team? Do we believe that by buying this business, we can slot them in quickly and they will continue to create value for our business? So really looking at the management team and the structure, do you have the right people in the right places, the right competencies? Owner dependency is a massively important area for SMEs, and a hugely important consideration for corporates. And and I've seen it so many times that the business is just far too dependent on the owner, and that creates risk for corporates. And going back to what you were saying, I mean, at the end of the day, a corporate They look at the historical performance of the business to be assured that this is a solid business, it's got a good track record, but ultimately they are buying the business for future cash flows. So really what they're doing when they're assessing a business is trying to identify risks to that future cash flow. And as I say, owner dependency would be considered to be quite a high risk for many deals. Also, areas such as really having all of your documentation, your financials, your legals, etc., everything, your contracts, all of that documentation is complete and accurate. And that's an area that some SMEs, sometimes do not have in place, but should be addressed before you take the company to the market. And then I think what's also really important as well is, understanding what it is that makes you different in your marketplace, and being able to communicate that and be able to show that to potential acquirers is really important, and really does make a difference to what that exit value is. So yeah, there's a lot of important areas that often SME owners, as I say, they're so busy in the day-to-day, and they're absolutely brilliant at the technical aspects of their job, but sometimes they do need that kind of outside look to really take a holistic view of their business and really advise them on where they need to potentially improve what they do, or fill gaps, or put in place new systems, new processes, etc., which ultimately will make a huge difference to delivering a successful exit.
Mark, you've touched on so many great points there. I think the one that I want to just highlight and bring up again is the way you linked the softer stuff to the valuation. So it started with stuff like culture, etc. You can't value culture using an algorithm. That's something you need to feel and decide for yourself if it's going to work. But something you did raise that I think you absolutely can put a number to is succession and owner dependency. So for example, in the BizVal models, and when we do valuations for people, we look strongly at bench strength, bluntly. And one of the ways we do it is we ask the founder, when last did you take a holiday? Did you turn your phone off? And how long was it for? That is one of the best ways to know for sure. And we know this as founders. You can never really switch off. If you are able to truly switch off from your business, it means you've got a proper team in place there, and they can actually run the place without you. And that makes your business a lot more valuable. And it comes through, as you correctly say, in the discount rate, which is applied to future cash flows. And for anyone who's not quite sure how that works, basically the more risk, the higher the discount rate. A high discount rate means a lower present value of the cash flows, or bluntly, a business that is not as valuable. And when there is owner dependency concern, then you would typically increase the interest rate, or rather increase the discount rate that you'll apply to those cash flows, and it brings the value down. So there's a lot of prep work that SMEs need to do before they go to market, and it really does pay off handsomely, because it can be the big difference between getting a very mediocre offer and getting a very good offer, which brings me to, I guess, what I want to ask you next, which is, in the South African market, and I wonder if it's the same on that side, there tend to be these rules of thumb for valuation multiples and what people are willing to pay. And then they're quite stuck on that. So quite a common rule of thumb in South Africa is 5 to 7x EBITDA. That is commonly used. And it's interesting because that rule tends to be the rule regardless of macroeconomic conditions, which is completely wrong, and prevailing interest rates, which is also completely wrong. But for some reason, this stuff becomes folklore in the deal-making industry. And I'm curious if it's the same on that side. Do you often find you're kind of working from, okay, here's the rule of thumb. Now let me tell you what I really think the answer is. Do people anchor to a number?
Yeah, I mean, absolutely. And I think that, within the SME market, if we're talking about, it's an overused phrase, but kind of traditional economy type businesses. So, your traditional engineering, manufacturing businesses, service type businesses like fire and security, for example. A typical range for a company which may be between £500,000 EBITDA to £1 million EBITDA. I mean, typically they would transact at 3 to 4 times, and that is a big generalization, and I think that's important to make that point, because there's so many other factors, as you know, that really do impact what that final multiple is. But certainly in the market here, if you were to go out and look for a traditional economy type business to buy within that range of below £1 million EBITDA, you would typically be looking at a range of maybe 3 to 4, perhaps 5 at a stretch, but certainly 3 to 4 would be my experience of where the market is.
So the most fascinating thing about that is that the multiples in the UK sound like they are arguably a bit lower than they are in South Africa for private businesses, which is completely the wrong way around, right?
Yeah.
If you look at macroeconomics.
Exactly. But again, and I think going back to the earlier part of the discussion is that, in my view, there are definitely, tactics and strategies that SMEs can put in place which would take them above that, in the UK, that kind of 3 to 4 multiple range. And I think, going back to the point that you made, is that for sure you need time to develop and implement those strategies and tactics. But if you do that, it really is, it really can pay back handsomely in terms of what that final multiple may be.
And the multiples vary drastically. I mean, there's been transactions in South Africa in the past week or so. I've seen companies change hands, and this is listed companies buying SMEs, so very much your wheelhouse. I've seen a labor broking type business change hands at about 2.5 times. And then a fire services business, for want of a better description, I think it was around 9x. So it just shows, how much it varies across sector. And we know this in Bisval, and I mean, you'll know this, Mark, is, it really comes down to how defensive the sector is, what the growth prospects are, how investors perceive it, what they're really looking for. And I guess that brings me to, one of the last questions I want to ask you, which is, which are the sectors at the moment that you are seeing as being quite hot, for want of a better description? Where is the activity at the moment in the UK?
Yeah, so I mean, I think that there are definitely a few sectors. So the ones that would be, at the upper range of multiples, so potentially 6, 7, 8 and above. I mean, it's areas such as life sciences, healthcare type businesses, renewable energy, tech businesses. I mean, I don't think that will be a surprise for any of your listeners. I think a couple of other sectors which, personally I've seen a lot of activity in is definitely fire and security companies within the UK. It's a very, very fragmented industry in the UK. I can't remember the exact stats, but there are many, many thousands of businesses within that sector. And it's a really interesting sector because there are a lot of complementary niche segments. So there is a lot of activity in fire and security where you have, organizations doing a buy and build, for example, because they can buy a platform business, solid management team, good size, etc. But then they can quite easily start to bolt on other complementary businesses within that sector. So you do see, or we have seen a lot of activity in that area, including private equity companies, for example, and not just trade buyers. Another sector which I've seen quite a lot of activity in, and I know people who are actually looking to consolidate in this sector is accountancy practices, actually, which is quite interesting. It's obviously a service type business, but again, hugely fragmented. And I think acquirers are seeing a really good opportunity to roll up multiple accountancy practices and potentially create quite significant synergies, particularly around technology. So we know that there's been quite a step change in technology adoption within the accounting sector, and definitely there is a lot of activity of buying up 5, 6 to 10 people practices and then rolling them in together. So, and then another sector which was pretty hot up until maybe more recently, but child nurseries. There was a lot of activity again of rolling up child nurseries. Very, very fragmented again. So acquirers are seeing an opportunity to create synergies by consolidating that sector as well. So there's definitely a lot of activity still going on, even though interest rates are obviously going up in the UK as well. But there are definitely significant opportunities across a number of different sectors.
I love these roll-up opportunities in the UK. They seem to be really popular. So we have a business listed here in South Africa. It's called Universal Partners. They've got a dentistry roll-up business in the UK as one of their investments. And as best I can remember, they did a large deal recently where they combined that business with another dentistry group. So it seems like these services businesses in the UK, that roll-up play is alive and well. Very interesting to hear those examples like childcare. So thank you. Those are good insights. I guess the last question from my side for this podcast, and it's been so great to have you on. I've thoroughly enjoyed this. To what extent are you seeing foreign buyers coming into the UK market and trying to mop up SMEs, or is that quite a rare transaction? Do most of the SMEs generally just change hands, among other sort of UK residents Just any insights you've got into that.
Yeah, sure. So, I mean, I think that I do see it happening. I don't see that, being a very common occurrence, in terms of overseas buyers. But certainly, for sure, there are definitely overseas, buyers within the market for sure. I know of, it's a private equity company, but not that big, but they are certainly quite active. A Canadian firm, who are certainly quite active in the market, and yeah, for sure that I mean there are definitely there's definitely an overseas presence in the acquisition market within the UK. But do I think that it's prevalent? Have I seen that it's really significantly increasing? I can't say I have. That doesn't mean to say it's not happening. But yeah, certainly there is some activity from overseas acquirers.
Brilliant, Mark. Thank you so much for these insights. It's been really great to chat. I think we can probably leave it there. For those who are looking to engage with you, contact you, obviously any advice around the market there or SMEs potentially in your network listening to this who want to reconnect with you, where would you direct people? How should they find you?
Yeah, sure. So obviously I'm on LinkedIn, so you can look for Mark Davidson, Crest Business Advisory on LinkedIn. My email, if your listeners would prefer to contact me directly, is mark@crestba.com, and then my website is www.crestba.com. So that would be the three main ways to contact myself.
Fantastic, Mark. Thank you so much for your time. It's been really cool. I'm sure we'll chat again. But all the best on that side of the pond, and enjoy the fact that when you flick a light switch, you have electricity. It's more of a blessing than you perhaps realize.
Yeah, absolutely. Well, I hope that gets resolved soon. So yeah, no, I really enjoyed the conversation, Ghost. Thank you very much.
Thank you.